Every once in a while, I get reminded in the comments of these videos that sometimes just because I have a good idea, it doesn't mean there might be a better way to play the same thing. And that's really what today's video is about. Today we're comparing Brookfield Energy Partners, which is a stock that I've been positive on, that I've thought is an interesting, positive way to play the Canadian renewable space. We're going to compare that with the Brookfield Corporation as a whole. And I'm going to compare these two stocks and talk about which one I think is a better option for you and me as a Canadian investor to profit from the green energy transition here in Canada. Welcome to Gold Large Investing. My name is Liam. On this channel, we love to talk about Canadian investing. If that interests you at all, please hit the subscribe button and like the video. It means a huge amount and doesn't cost anything. Like I mentioned, today it's all about BEP, so Brookfield Energy Partners, and BN, which is the Brookfield Corp as a whole. I want to give a big shout out to everyone who mentioned this to me in the last little while, particularly those who pointed out that BN might just be a safer, more profitable play than BEP, and who really changed my mind about this whole situation and made me ask this question in the first place. Okay, let's dive straight into the metrics. And I've got this pulled up on the screen right now. I wanted to look at a couple different things for each of these corporations. And specifically, I wanted to talk a little bit about revenues and I wanted to talk a little bit about profitability because I think that's really interesting. And so the site that I have up on the screen, this is FinChat. If you haven't heard about them, if you haven't seen them in any of my videos or anybody else's, it's a really positive Canadian company that helps a lot of us research these companies. And they have a great system that lets us look at specific metrics at over time change, at sort of compound rates, all sorts of cool stuff. If you're interested, I strongly recommend checking them out. So we're going to start here with Brookfield Renewable Partners because that's a company I've talked about lots on the channel. It's a company that I'm positive on. I personally think is probably the best of the Canadian renewable energy companies. And they have some pretty awesome total revenues. I mean, if you just look at the 2024 numbers, we're looking at, and this is in millions, so $5.87 billion. If we look down at the bottom there, we're seeing the total change in the last 10 years is sitting at 260%, compound annual growth rate of 15.31%. So big growth, big revenue number. Okay, revenues look great. Top line, always a good thing to see. We're seeing solid growth, 15% revenue growth. That's nothing to sneeze at. That's pretty impressive. That's up there with some of the fastest growing companies in Canada right now. So let's go next on the list. Let's look at profitability. And the first number I'm going to put up here is just gross profit. Just gives us sort of the most broad outline of, okay, what does profitability kind of look like? Well, we're seeing about a 200% total change in the last 10 years, just compounding at 12.9%. So pretty excellent growth. Again, we're getting above a 10% compound growth rate here, 200% in the last 10 years. I am a fan. Next up, we got EBITDA. For those who don't know, earnings before interest, tax, depreciation, amortization. It's one of my personal favorite ways to look at earnings because it really does set sort of a base for like, okay, what exactly are you earning? And it doesn't let companies that are dealing with financials get totally skewed compared to others. And it'll help us in this comparison. EBITDA, we're looking at 200% total gain, compound annual growth rate just above the gross profit at 13%. A 13% compound annual growth rate would be fantastic. If I could do that on my portfolio every year, I mean, that gets me to my end goal pretty quick in the grand scheme of things. But let's jump over to the Brookfield Corp and I'll show you guys just how different some of these numbers can look. So first off, let's talk revenues. Numbers are going to be a little bit different here because we're looking at last 12 months versus just the 2024 numbers. But still, we're looking at a pretty fantastic number. I mean, again, in millions, we're looking at 91 billion and 98 million. So that's huge, right? We see this big dark blue bar on the screen, pretty tall. Now, we do see a better 2023, but then again, we don't have the full 24 numbers. So you never know. Maybe the end of 24 is going to sort of bring that number up a little bit when it finally does come out. Next up, gross profit. Again, nice sort of crude way to see profitability. And we're looking at that. It's up 231%. Their gross profit is somewhere in the range of 22 bill. And we're looking at a compound annual growth rate of about 13%. So gross profit is about in line. Here's where things are really different. EBITDA, we're looking at a total change 328.17%, which is a compound growth rate of 16. So those couple percent compounded every year for the last 10 years means that the total change is literally over 100% better than we were looking at for Brookfield Renewables. Okay, so that's pretty fantastic so far, right? We're looking at some pretty fantastic numbers there, but that doesn't tell us the whole story. The financials do look better for Brookfield, but that makes a lot of sense. If you're not super familiar with the sort of web of corporations that is Brookfield, the parent company, which is this ticker we're looking at, BN, it owns big chunks of all of these sort of sub companies in all of these different industries. And so it makes a lot of sense that the parent has the most profitable assets under their wing, while investors can choose to pick up other slightly less profitable assets. But we're not looking at a huge difference in the grand scheme of things. I mean, revenues were compounding at 17 over here, we're compounding at 15 over here, but Brookfield Renewable Partners is a much more targeted stock. So let's talk about a couple of the other things that might convince you as a stockholder. One of the things I wanted to look at was dividends, because dividends are really important to me. That's one of the main reasons I own either of these companies, is for dividend yield. Well, if I go down to the dividend yield, again, we're looking at Brookfield Renewable Partners here on the screen, a dividend yield of 6.7%, which is a pretty solid dividend yield. 6.7% is actually pretty fantastic. If that can be maintained, that is awesome. You would love to see that. We're looking at the dividend per share at about $1. We're looking at the growth over the last 3 years of 5.2%, 5 years 5.2, 10 years 3.2. And they're expecting about 4.9 for the next 2 years. So it looks pretty consistent. That growth rate is pretty good. In the grand scheme of things, a 5.2% dividend growth rate, that's going to keep you ahead of inflation. And that's really what you want to worry about when you're in something like this, right? If you're looking for sort of longer term stock appreciation because you believe in the energy transition, but you also want to sort of have that dividend that pays you to hold this as there's potentially rocky waters ahead, you do want to see them projected to continue supporting that dividend and growing it ahead of inflation. Now let's go over to Brookfield, the parent company here, because the dividend story here is very different. We're looking at a dividend yield of 0.5%. It doesn't even register as a cent per share. Dividend per share growth is not good. We're down considerably. It says negative 15% over the last 3 years, down 6% over the last 5 years, and up just a little bit over the last 10. Very different story. However, they are expected to grow their dividend 11% in the next 2 years. So dividends, if that's where you're coming from, maybe the parent company here isn't where you want to be. So that makes us think, which one of these has a better total return? Well, again, we're going to start with Brookfield Renewable Partners. And let me look at just the 5-year total return chart. That's not great, hey? We're looking at a 10.5% total return, which is a compound annual rate of 2%. Okay, what if I stretch that right out to about 10 years? Get that chart just about right. Okay, now we're looking at 146% compound annual growth rate of 9. But you'll see, since 2020, there's not been a huge amount of growth. There was a big peak back in 21, as it feels like there was in all things. But this company just hasn't quite recovered. And I think that makes sense. Remember, this is a renewable energy company. I don't know if there was ever a better time for these companies than 2021. That was when we saw people willing to put that high multiple on companies that were delivering the future. Everybody was investing in stuff like this. They all believed it could be the next big thing. I mean, look at the EV stocks that popped off, right? Obviously, a company like this that's kind of in that same world is going to see a higher multiple. And they haven't been able to do that since. Now, let me just take you over to the Brookfield chart. Now, remember that that 10% 5-year chart we were looking at earlier for Brookfield Renewable, well, as you'll see, very different chart for the parent company. Now we've got a lot of flat on this chart. And then here comes 2024, and we're up 100%. Not quite, I should say. It's technically giving me 99.8%. So not quite double your money. You're 0.2% off double your money. But it's a compound rate, 14.8%. That's huge. That is huge. Doubling your money in 5 years in a stock that is not new tech, that is not like an explosive AI stock, that is not like a commodity-based stock, right? Like a gold miner or a junior miner, any of those sorts of things that can just sort of explode and investors just expect it. This is a solid, diversified giant that's up double. Huge. And let's drag that out, just like we did for Brookfield Renewables. Let's drag that out to about 10 years here. Here, I gotta adjust this chart just a little bit. There we go. 319%, and it's keeping that compound rate at about 15%. And just look at this chart, guys. Up, 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 up. And yes, there are dips, right? If you bought in 2022, for example, and you decided for some reason to sell in the middle of 23, sure, you were down. If you bought February 2020 and you sold in March, yeah, you were down. But basically anywhere else, you're up huge. And of course, if you're still holding and you bought basically any time before last month, you are up huge on this company. The return, the total return is fantastic here. That is huge. If you could triple your money in 10 years in a big diversified giant, why wouldn't you? And particularly look at all the opportunities you had to buy, right? Even after it went down, you had all of these opportunities to buy when it was up 60, 70%, when it was up 100%, and you still would have doubled your money or almost tripled still for the 60 to 70% folks. So really, really impressive numbers from Brookfield as a sort of parent company. And I think that's where this debate has to sort of leave the numbers behind. And we should just talk about the core question. Which of these two companies aligns best with what you are trying to do as an investor? And I think that's where the question for me becomes, are you interested in specifically investing in a renewable energy company? Or are you interested in one of the largest conglomerates of various industrial and profitable businesses? This is a giant asset manager. This is a multinational corporation. And which of these you want to own? Because as we've clearly shown, the past 5 and 10 years tell us that actually owning the parent company will return better results. The only counter argument that I might have is that if you believe that the energy transition is coming and you want to be positioned for that specifically, I mean, the results from Brookfield Energy are nothing to sneeze at. No, it is not up big over the last 5 years. But if you think that maybe this has been a buying opportunity and that part of the business will outperform the whole, then I see the argument. If you're just looking to continue building on a diversified Canadian portfolio, you're looking to grow your portfolio in the long run, there is absolutely nothing wrong with holding on to Brookfield. That is a fantastic company. And I think it probably makes sense in my portfolio and in lots of yours. I think Brookfield is a fantastic company, fantastic growth. Clearly, they are returning value to shareholders, even though it's not in a dividend format, which obviously for those of us who are building a dividend growth portfolio, who are taking advantage of being Canadian and having access to things like TFSAs and RRSPs in order to have the most tax advantaged way to collect dividends, right? Maybe that's not the way we're getting this value returned to us, but still, Brookfield, fantastic company. Brookfield Renewables, this is your option if you're looking at that sector to outperform. And in all honesty, I think in my portfolio right now, I'm not sure which of these I'd pick because I see both arguments. Obviously, Brookfield is outperforming. And actually, probably the safer bet because we are in for what looks like, from just a sort of outsider's perspective, like a renewable energy winter. To use the term that has been coined by so many Bitcoin enthusiasts, where you see the cycle rise and then fall. And then it sort of flattens out in what the Bitcoin and crypto community calls their winter period, where basically prices are low. And the job of a crypto investor in those times is to invest to dollar cost average, to buy more, to load the boat. For the summer or the spring or the sort of renewed interest that shoots valuations up. Now, we've seen, and if I click back over to the sort of stock price in Brookfield Renewables, we've seen at least one period where the price shot up. If you had owned in 2020 or even early 2019 and you had sold at the start of 21, you could have made hundreds of percent. And maybe this time period we are in, as we watch the price sort of trickle along, maybe this time period actually is a winter period where sort of future outlook is being artificially held down by current events, but that these companies can perform. Maybe that is going to happen. But I think maybe holding the parent company in this case, the ones who have lots of other profitable ways to grow their business while the renewable space is at a weakened state, maybe that makes a bit more sense for me in my sort of bull case. But that's about all I have for you folks today. Let me know, which of these two do you prefer? Are you specifically in it for the targeted renewable energy play, or are you interested in the parent? Do you think that owning the whole is probably worth more than just owning that one piece? Please do let me know in the comments down below. And if you watched all the way through this video, if you're interested in this kind of content, please do subscribe to the channel and like the video. It makes a huge difference to us and it doesn't cost anything. And with that being said, I hope I see you in our next video.